All right, let's get right into it. We're going to tackle one of the most misunderstood and, frankly, most dangerous areas in finance, options trading. And, more importantly, we're going to look at why so many people crash and burn and how you can think completely differently to make sure you're not one of them.
So let's just start with the cold hard truth. That number you're looking at, 90%. According to the folks who run the show, the Chicago Board Options Exchange, a staggering 90% of options traders lose money. That's not a scare tactic, it's just the reality of the game. 9 out of 10. That one number is exactly why we need to talk about this.
So why? Why is that number so ridiculously high? Well, this quote right here absolutely nails it. It's all about a fundamental misunderstanding. See, beginners see those crazy stories online, right? Turning a few $100 into thousands overnight, and they think, hey, I found a golden lottery ticket. They're just chasing that massive payout, completely ignoring the math behind what an option really is. And that mindset? That's the super highway to becoming part of that 90% club.
Okay, so to break that cycle, you have to completely reframe how you're thinking. And here it is. This is probably the most important mental shift you can possibly make. Stop thinking about options as lottery tickets. Start thinking about them as insurance contracts. I know it doesn't sound as exciting, but this one idea, this is what separates the pros from the crowd.
Now, this slide just breaks that insurance idea down perfectly. On one side, you've got the option buyer. Let's call them the gambler. They pay money, a premium, for a low probability shot at a huge win. It is, by definition, a negative expected value game. It's just like buying that lottery ticket. But on the other side, you have the option seller. Think of them as the house or the insurance company. They're the ones collecting the premium. They operate with a high probability of success, and they profit from the math, over and over across time. They have a positive expected value. The pros, they want to be the house, not the gambler. Every single time. But believe it or not, it actually gets worse. If you're just out there buying options, you're not only fighting the terrible odds we just talked about, you're also fighting two invisible forces that are constantly, relentlessly working against you. And those are time and volatility. The first enemy is something called theta, or time decay. And here's the best way to think about it. Every option you buy is a wasting asset. It's like a melting ice cube. Every single day that passes, it loses a little piece of its value, just because time went by. And this decay, it's not a slow, steady drip. It accelerates like crazy as you get closer to the option's expiration date. It's a silent killer that just eats away at your position, even if the stock doesn't move a single penny against you. And that brings us to the second enemy, which is volatility. And this right here is a classic beginner's trap. Everyone loves to trade around big news like earnings reports. But here's what happens. Before the news, uncertainty is through the roof, right? So option prices get pumped up, they get inflated with what's called implied volatility. Then the news comes out. Bam! All that uncertainty is gone, and that pumped up volatility just collapses. It's called the volatility crush, and it can absolutely demolish the value of your option, even if you were 100% right about which way the stock was going to move. It's wild. So, knowing about these two forces that are always against you, let's really zero in on the single most common, most destructive mistake a beginner can make. I mean, this is the one thing that probably contributes more to that 90% failure rate than almost anything else. And there it is, buying these cheap, far out of the money options. Now, all that means is you're betting on a huge, unlikely move. It's like betting a stock that's trading at $50 is going to suddenly shoot up to $80 in like a week. The allure is so powerful because they're cheap, but it is a mathematical illusion. The probability of these things ever becoming profitable is incredibly, incredibly low. It is the purest form of that lottery ticket mentality we talked about.
And if you don't believe me, well, the data couldn't be clearer. This chart pretty much says it all. Historically, about 90% of these so-called lottery tickets expire completely worthless, zero. You might hear the one story about the person who got lucky and hit it big, but you never hear from the other 9 people who bought the exact same kind of ticket and lost every penny. The numbers just don't lie.
Okay, so that was a whole lot of don't do this, don't do that. So let's pivot. Let's talk about the constructive way, the professional path. How do you even approach this market in a way that gives you a real fighting chance?
The way forward is a process. It's not about one lucky trade. It's about building real competence. So first, education. You got to start with a paper trading account, one with fake money, so you can learn the mechanics without risking a single dollar. Then, you practice with real money, but, and this is key, you trade incredibly small.
The goal isn't to get rich, it's to feel the real emotions of having your money on the line and to see if you can actually stick to your rules. And finally, the most important part, discipline. Professionals are obsessed with managing risk. Returns are just a byproduct of good risk management. This is how you start to think like the house, learning strategies where you're the one collecting the premium and letting time work for you instead of against you.
Which brings us all the way back to the main idea of this whole thing. It really all boils down to this one simple question. Are you the gambler? The one paying for a low probability bet while fighting against time and volatility? Or are you the house, the one collecting the premium and putting the mathematical odds firmly in your favor? Your answer to that question will pretty much determine which side of that 90% statistic you end up on.